Hi, I'm Steve King, CEO of GrowthForce, and welcome to Put Your Numbers to Work podcast. I'm really excited to introduce one of my closest friends and my longest term advisor, Jeff Brown from Quorum Group. Welcome, Jeff.
Thank you, Steve. Glad to be here.
It has been a great journey we've had. We've known each other since, I think, probably the month we moved here, because our kids were in like kindergarten together, right?
That's right. Pines Montessori.
Pines Montessori School, and I was immediately attracted because of your work with small businesses. You were at the time the CEO of an IT company, right?
Of a software company, that's right.
Software company, right. And had a passion for helping grow that business. You know, talk about your experiences there. You exited that, and then how that translated to what you're doing today at Quorum Group.
Sure, I'd be happy to. Well, at the time we met, you're right, I was CEO of a software company. It was a public company subsidiary that we had worked hard to build up and get it ready for sale. At the time I left, we had just sold it to our major competitor here in town, a large global IT integrator. And I left just before we started integrating that business with the acquirer.
And how did that translate into what you're doing now?
Well, I think it created an opportunity to re-examine my career and decide what to do next. And I didn't want to move back into another operating role. And as I moved through my sales career, becoming CEO in a couple startups, the deals we were doing, what we were selling, they were having a greater and greater impact on our customers. So I was looking for an opportunity to actually engage in something a bit more complex, a transaction or a deal that was a bit more complex. And what I found is selling your business is one of the more complex transactions that you can undertake.
Sure, even harder than starting the business, right? You just need to go to Staples and get a phone.
Well, I don't want to take anything away from the folks who have the ambition to start their own business, because building something out of nothing is a really tough challenge.
Yeah. So now you're at Quorum Group. So what's your role there, and what is Quorum Group?
Sure. Well, Quorum Group is a boutique M&A advisory firm, very focused M&A advisory firm. And we fit into the category of investment bankers, but we're very specialized. All we do is help executives, owners, and investors in small software companies and technology-enabled services companies prepare for and sell their business. We are based in Seattle. We have international headquarters in Zurich. We're about 40 people, and my role is I'm one of the client executives. I'm senior vice president with the firm, client executive, and I recruit, work with our client companies to prepare them for sale and then move them through the whole process of the transaction.
So I've bought and sold a couple of companies, and you're the guy that I go to for that advice. So I'm interested in you sharing some of the lessons that I've gained from working closely with you. Businesses have different life cycles, right? You get started, you're growing, you emerge, and what we're really talking about is exit strategies, right? The merger and acquisition is really at the end of the life cycle. Where do you get started if you want to sell your company?
Sure. Well, actually, selling your business can be a step in the life cycle, an important step in transitioning the business through the life cycle. The reality is that most of the technology businesses in this country are not passed on to the second generation.
Any businesses,
Most
right?
any business.
Right.
They are one generation businesses. So eventually you're either going to sell the business to create some liquidity and personal wealth, or you're going to sell the business so that it's assured of moving forward, growing, continuing to grow. Often entrepreneurs outrun the resources they have available to grow the business. And it's time to move it into a new environment where the employees, the customers, the business can continue to flourish. Right? So preparing for that transition is what we do.
So when you do that, if you want to sell your business, if I want Jeff Brown to help me sell my business, do I go and say, okay, I'm ready to sell my business next week, let's talk?
I'd rather you come to me 18 months, 2 years before you want to sell the business. Say, hey Jeff, I'm thinking about selling the business. Tell me how I should prepare the business. What do buyers value? How do I position my business so that A, I get a lot of attention from buyers, and B, I get a good valuation and deal structure from the buyers. Right? The best way to sell your business is to have multiple interested parties. So we call it competitive tension. So you want to create interest in your business from many buyers. What you don't want to do is respond to the first inbound inquiry that comes in the front door. What you want to do is create a little bit of an auction environment, competitive tension.
Or feel like you're in a rush because you didn't give enough lead time.
Exactly. So you want to control the timing. You want to adjust the timing, control the timing as best you can for this sort of thing.
So what do you need to be doing to get ready? If you say, okay, it's 2 years from now I'd like to sell my business, or 18 months from now, and you're going to have that initial conversation, what are the things that you want to be thinking about to get that prepped up?
Well, we could spend a whole hour or two on that. There's a lot to think about, but I think we can distill that down into a couple principles. But once again, you want to create some competitive tension. What we like to say is businesses are sold, not bought. So it's a sales process. You want to package up your business, wrap and pack it as I call it, so that buyers can understand it, that they have confidence that they fully understand all of the risks and strengths associated with acquiring your business. And building that confidence that they understand is what's going to give you the best deal. Now they're going to look at how well you're executed, what I call execution strength. Right? And the numbers are a really good indication of your past execution strength, how well you've run the business, how well the business functions, how successful it is. And your game plan is a reflection of how well the business is likely to perform. Because now you're putting in place a getting better agenda or a growth agenda or a strategic agenda. It's your business plan for growing the business going forward. And you measure your success with the numbers.
So that's why you're here, right? It's Put Your Numbers to Work podcast.
Put your numbers to work.
And so what's the difference between the companies that are successful in selling their business and the ones that struggle?
Right. What I like, to paraphrase a football coach, an NFL football coach, or not to paraphrase him, to use what he says, you are what your record says you are. So let's go back on that one for a second. You are what your record says you are, right? So your numbers are your record, right? So you want to make sure that the numbers properly reflect the way you've been running your business and reflect what you're measuring in your business, the aspects of your business that you judge are important to the way you operate the business, the decisions you're making, the kinds of initiatives that really drive the business forward.
So what are those things that buyers are looking for? What are the drivers of that success?
There's 3 categories of attributes that buyers look at. There's going to be your market. Generally, they fall into 3 buckets. One is your participation in the marketplace. Who are your customers? What's the marketplace look like? Is it growing? Is it shrinking? Right? How long do those customers stay with you? 2 is the strength of the operations of the business, your management team, your product set, your inventory, your fixed assets. Is this a balance sheet oriented business or is this an income statement oriented business?
What's the difference?
What's the difference?
Because most CEOs that I hear, our clients come to us, they don't ever look at the balance sheet, right? They look at the top line and the bottom line of the income statement, and then they file the paperwork away. Why do you need to look at the balance sheet?
And most of the businesses that we're involved in are actually purchased, we would say, off the income statement rather than the balance sheet. But the balance sheet, they're largely asset-light businesses.
Service businesses?
Services businesses.
Technology.
And if you look in your business, most of the assets of this business are tied up in the people that you have working for you, rather than in the desks and the computers that you have.
Right.
You don't carry inventory, right? You don't have work in progress. So that's really the picture that most services of businesses represent. Tech-enabled services businesses or software businesses, right? So the balance sheet becomes important from a working capital perspective. Do you have enough working capital in the business, enough liquidity in the business to continue to grow, to fund the growth, to pay the bills, to keep the business operating? Or do you have a working capital deficit? That's really the most important thing in the kinds of transactions that we're involved in, representing the services businesses that we're involved in, that you look to the balance sheet for. The rest of it is taken from the income statement.
So what are you looking for there?
Number of things. Excuse me. Certainly, top-line revenue. Is the revenue growing? What's the composition of the revenue, right? how does revenue growth compare to market growth? It's an indicator. That will tell you whether you're expanding your share in the marketplace or the marketplace is outgrowing your business and you're actually losing share in the marketplace. Those sort of dynamics are important.
So dig into that a little bit. So how do you measure that? I mean, you know, I know what we're doing with GrowthForce and our growth, but I'm not comparing us against, you know, other size, other client accounting services firms. So you're suggesting that's an important thing to do early on?
It's an important attribute to understand. Now, it may not be particularly relevant in your particular business because, for example, the size of the market is very large. You're a small player. Right? The CPA marketplace, the bookkeeping accounting marketplace is very large. Every business needs your services. Right? So your position relative to the total market, whether you're growing share, may not be so important for your business. For others, it may be. Right? So, but it's important to understand how you fit in the ecosystem that you participate in, and whether your strength and your footprint is growing or shrinking. It may not be the most important attribute of your business, but you want to understand how you fit. Because buyers, remember, buyers will look at your business differently than your clients will. And the way you prepare and present to your customers is going to be different than the way you prepare and present to buyers. Buyers will value your financials, they'll value other aspects of your business, the strength of your management team, where customers or clients may value and only evaluate the strength of your service offering.
Right.
Right.
The products,
or
your team, the delivery.
The team, the people they engage with on a project basis.
Processes.
Exactly. So buyers will be looking at different things. Buyers have choices. If they're looking at buying your business, it's very likely they're looking at half a dozen to a dozen other businesses that do similar things. So what you need to be prepared to do is express the strength of your business and how you're different and a better investment than the other buyers, the other sellers that they're looking at.
So I've heard the phrase that investors invest in three things. They invest in management, they invest in management, and they invest in management, right? Is that
right.
Is that an accurate statement?
Management is going to be a very important part of it, yes, and it's an accurate statement, right? But what I look for, and when I look, especially looking at technology companies, the three attributes are team, technology, and market, right? So in a services business, management is far more important, I think, than it may be in a software products business. But management is always at the top of the list.
So you mentioned there was the market, there was the management.
The operations of the business, and then there's the financials, right? And what do the financials tell you about the operation of the business and its success or lack of success in the marketplace? The numbers or the financial attributes can also tell you about the plan the management has in place for growing, changing, evolving the business.
So companies that are successful in getting their number and the companies that struggle to find even a buyer, what's the difference if the numbers are so important? What are the kinds of things that you should have in those numbers?
Right. Good question. And let me take a moment to get to a specific answer there. There's a perception that going to market and talking to buyers and not finding the deal you're looking for is a failure. It's not. Going to market and talking to buyers is probably the best management consulting exercise you can undertake. Understanding why your business is valuable and why it's not is a very important management tool. It's management consulting. Because most entrepreneurs...
It's free consulting, actually, right? No, you pay a broker. I mean, you pay an investment banker.
You pay an investment banker. It's
Right.
not free,
Right.
But it is high quality, especially if your plan is to exit the business at some point in time. I like to recommend that serious entrepreneurs who are looking at selling the business at some point in the future test the market early to really understand. Now, we all do test marketing with our products and services, right? We roll out in beta, see how the reception is, adjust, tune, adapt, and then roll out the product or the service in its final form for the marketplace.
It's so interesting.
The same is true for businesses. It's very valuable to test market the business, right? And also remember that at some point in time, it's your job as the leader to understand the value of your business in the marketplace to potential buyers, right? Because your job is to create shareholder value in the business, right?
So it's really interesting. So what you're saying is that if you want to sell your business, the first step isn't necessarily to go out and find a buyer. It's to go find out what kind of things the buyer values.
Exactly.
What's the response to the buyers? So then you take the next 18 months to 2 years to help focus on increasing that economic value, so that when you get the transaction, you've done the homework.
Exactly, exactly. Now, if you're working with an experienced advisor, they can predict. They can help you understand before you test the marketplace, what are the aspects of your business that a buyer is likely to investigate, want, or what buyer is likely to value. Right, we talked a little bit about those things. Remember, each buyer is different. Each buyer has a thesis or a thesis that they are chasing with their investments. We sell companies to two types of buyers. Strategic acquirers, who are other operating companies in the business. They have similar operations, and they want to buy your business because you add customers, you add product, you add geography. Management, revenue, processes. They like your revenue model, for example. Those are some of the attributes.
Like you sold your business to a competitor.
We sold our business to a competitor.
Right.
They wanted our products, they wanted our customers. In our case, we happen to have 7 out of the top 10 customers in the marketplace, right? They wanted those big accounts, and they wanted to roll some of our products out in those accounts and some of their products out into those accounts. So those were some of the reasons why they bought us.
So that's the first type of buyer, strategic buyer. What's the other one?
The second kind of buyer is a financial buyer, a private equity acquirer. Somebody with money, somebody has a thesis on the marketplace that they're chasing with their investment dollars. And so they're going to buy your business, going to help grow it for a couple of years, 3, 5, 7 years, and then look to exit the business at some point in the future.
And would family offices fall into that category?
Family offices would. And actually, for a business like yours, services businesses, family offices are very attractive buyers because they tend to acquire, hold on to the management team, hold on to the business as it's been running, and treat it as an investment for the family.
For a long term.
For a long term. So what you get is a very supportive partner, some good advisory perspective on some experience perspective on the board of directors, right? And some capital to help grow the business.
And they're often more passive than a private equity or
Exactly.
venture capital, so they're not going to come in and tell you how to run the company.
Right, right. For many entrepreneurs, they've been operating almost alone. For an individual who started his business out of his wallet and has grown the business, he doesn't have, many entrepreneurs don't have a board of directors or a board of advisors or fellow investors with whom they consult on a monthly basis.
That's why Vistage is so popular.
Vistage is a good tool to replace or take the place of a board of directors.
Yeah.
But when you sell your business and you think about continuing to operate it, you're going to become accountable to somebody.
Right.
Right? And a board of directors can be a very powerful ally in growing your business, taking it to the next step.
So you've got these different types of buyers, right? And they've got different goals and objectives and measures of success. How do you go to those different buyers from a position of strength, right? How do you measure strength?
Right, right. And there's once again, buyers will measure what they value, and each buyer will value different attributes of the business relative to their perspective. Right? I had a colleague who used to say, "Where you stand on the matter depends on where you sit." Right?
What does that mean?
It means that where you sit, your perspective on the world will influence the way you evaluate things.
Right.
So each buyer is different. And you have to look at them contextually. What are they looking for? What's their agenda? What's their strategy? And how might your business fit into their strategy? But they all use similar metrics for evaluating the business. And a couple of examples would be, there's a concept of R value, right? R value.
I love this concept.
Yeah, this is a good one.
Yeah.
It's a good one. And it's very useful for comparing one business to another. So the R value is a number, right? And it's the sum of two elements of your business. You take your year-on-year revenue growth, which might be 15% per year, and you take your EBITDA percent of revenue, which might be 20%.
So earnings before income, taxes, depreciation, and amortization,
That's
EBITDA.
right, EBITDA, which is probably the best metric on the P&L for the efficiency of the operations of the business.
And it's a good placeholder for cash flow.
It is.
Right.
It's a good proxy for cash flow. Right. So in this example, a year-on-year revenue growth of 15% and an EBITDA percentage of 20% gives you an R value of 35. Is my math right?
Yeah.
Good. Gives you an R value of 35.
Mhm.
Now you can compare that R value to the R values of other similar businesses or dissimilar businesses if you're looking for a good place to put your money as an investor. Right? So for a software company, the average software company operates at an R value of 25.
Because you got high growth, high margin.
You got high margin because software companies scale differently than service companies. Gross profit margins are typically higher. So they operate with an R value of 25. One standard deviation away from that is an R value of 50, right, for a software company. So the top tier performers perform at an R50 value or greater. They're either growing fast, revenue is growing fast, or they're cash machines. They're
Right.
generating a lot of cash.
Right.
So if you have a company with an R value with 5% coming from revenue and 45% coming from EBITDA, that tells you they're probably an older, more established business that's just in a harvest mode,
Yep.
just spinning off cash.
Now, one of the things I love, you've talked about how not all revenue quality is the same.
Right.
Can I talk a little bit about that?
Sure. And this is something that buyers will spend a lot of time taking a look at, is the quality of revenue, the type of revenue and the quality of revenue. And your P&L, when you organize your numbers and you look at revenue, you really need to understand revenue by type, revenue by the type of service or product, revenue by type of customer, revenue by geography, so you can start to decompose the top line revenue. Revenue is not created equal, right? So certain revenues generate greater profitability, gross profit margins, than other types of revenue. Certain types of revenue are more valuable to the business than other types. So a couple of examples are product revenue. Software product revenue has higher gross profit margins than services revenues. And you can sell more of your software product without adding cost of goods sold.
Because you need people to do service.
In the services world, that's right, you need people. Services businesses scale a little bit differently. You need to add more people to grow that business, so the profit margins are lower. That's not to say one is better than the other, they just behave differently, and we need to understand that.
The models are different.
That's right. When you look at revenue, net new revenue from new customer logos may be more valuable than growth revenue or expansion revenue in the existing customers. Right? So if you're in for example, a dynamic, fast-growing marketplace, generating additional revenue from existing customers may not reflect adequately the strength of your position in the marketplace. But revenue from net new customers means that you may be expanding your share or at least keeping pace with the marketplace expansion.
And more opportunities for add-on sales overall, right?
That's right.
So I remember you counseled us very early in Growth Force's life. We did a lot of project work. We QuickBooks consultants, right? That was our primary business. We had a whole team of people going all over the country, serving clients all over the country, and you encouraged us to shift to more of a recurring model, which is when we added the outsourced bookkeeping, accounting, and controller services. Why is that important?
Right. One of the important attributes of any business, for any manager as well as a buyer, is predictability. Predictability of revenue, predictability of profits, predictability of cash flow. Recurring revenue models give you that predictability. Because what you're getting from your customers are a commitment over time, consistent, predictable commitment to buy your services, consume your services, and pay for those services over time. So even a services company that does projects, if they can get closer to a recurring revenue model with their customer relationships, that's going to be more valuable both to the running of the business and to a buyer, because you get that predictable revenue, cash flow, and profitability.
And I was surprised, it's actually better for our clients as well, because they're able to take their annual spend and spread it out evenly over the course of a year, so then they can budget, they can manage their cash flow, they don't have this, ups and downs.
That's right.
So for any business, any service business that has repeat clients, you can turn that into an annuity, which
You should always be looking for a way to turn that into an annuity or a recurring revenue business. Some services businesses, construction businesses, for example,
right.
software implementation businesses are going to have a hard time getting to that recurring revenue model over an extended period of time.
Right.
But execs should be thinking about that, should be working towards that kind of model. Right?
So the R value is a big one, the revenue quality.
Revenue quality.
And then my love language here is kind of the unit economics, right? The gross profit and the customers. I know how that's a big thing for you. Talk about why is that so important to a buyer?
So, and perhaps a little bit of explanation around what unit economics is. It's really all about a unit of one, right? Distilling this down or breaking down what you do to a single unit, a unit of one, and then how many times do you repeat that unit of one, right? And so that's really tells you how efficiently businesses can scale. So if you can break down revenue, profits, cash flow to a unit of one, you really understand your business at a granular level. And then you're just adding grains or bricks from there as you add multiple units, right? So unit economics would start to get you towards profitability by product, profitability by customer, profitability by job. Right? In the services world, especially the project services world, profitability by job is a really important attribute. And many companies who aren't accurately tracking profitability by job fool themselves into thinking, because I'm generating a lot of revenue from this customer, I'm very profitable with this customer. And that's not always the case. Big customers, even little customers, can be cash sinks, profit sinks. And if you're not tracking at that level, the unit economic level, then you can really fool yourself.
You know, I see this so often. We had a technology company out in the Northeast that had Apple as their biggest account. It's like 40% of their revenue. They're so proud of it. It was where management spent most of its energy, but they couldn't figure out why. You know, they're an 8-figure business. They couldn't figure out why they weren't making any profit, and it's because that was a cash sink.
Yeah, yeah. One of the hardest concepts for an entrepreneur to embrace as he's growing his business is once he gets revenue by customer, profit by customer, profit by product information out of his dashboard, out of his growth force relationship, is to now make decisions about which customers he needs to fire.
Right.
Because they're not profitable.
Right.
Firing a customer, especially for a growing business that's scrambling for every dollar, is a really tough decision for an entrepreneur.
I remember this conversation. She said, "Fire Apple? I need the cash flow.
Yeah.
If I fire Apple, I'm going to, how am I going to make payroll? It's
Right.
a third of our business." And what we found was, we were to show her, is that, if you have knowledge workers, it's hard to find workers, but by redeploying those from a bad money client to a good money client, it went right to the bottom line. She ended up with $1.5 million in profits in the first year after firing.
That's a terrific story.
Isn't it though?
Yeah.
And it happens all the time. We've got dozens of them, because you think, who's your best customer? Every CEO that I talk to will always say, well, our largest one, look, here it is. And then when we go in and do the job costing, it's not even close, because so much management time, the expensive people, are spent on the biggest customer.
Right, right. And it's important to capture the time you spend servicing your clients.
Yeah.
Because if you're not capturing those costs, you really can't fully understand whether your client, your customer is profitable. And let's not. It's a tough decision to fire a client, especially a big client.
And there's a relationship there.
There's a relationship. There's the revenue. It's a tough decision. So I don't want to suggest that it's not.
Right.
But you have to make those hard decisions. And your business will be better off for it.
We have developed a process where we go to a client, give them an option. Like, here's the 3 options. One is, we need to increase our fees to reflect the value that we're giving you, the scope of the work that we've evolved to.
Right.
We need to cut our scope back to what we originally agreed on so we can keep the fee the way it was, or we need to transition to another partner. And I've been surprised, when I studied, 82% of the clients stick with the service provider, because if you're doing good work and you can explain your value,
That's right.
you don't want to.
That's a really good concept. Is if you're creating value for the customer, very often they'll rework the relationship to reflect the new value or the evolving value that you're creating for them. and you don't have to fire them.
Right.
And before you fire them, you need to fully understand what you're delivering and have a sit down with the customer and explain the challenge that you have with the customer. Most good customers want to see you successful,
Right.
right? They don't treat you as
Vendor.
as a vendor.
Right.
They treat you as a partner.
Right. And that time tracking is critical, even if you don't do billing by the hour. Because a lot of companies say, well, we don't bill by the hour. It's like, no, it's not about billing. It's about visibility into the time leakage and the hidden costs
Right.
and the...
What you might find, though, is it's not that the customer is being recalcitrant, difficult, unprofitable. It's that your internal processes may need some tweaking.
Mm-hmm.
Or you may need to adjust your talent,
Mm-hmm.
right? Put the different talent on this project because you've misaligned your skill set with the needs of the project or the service engagement.
Right.
Well, you know, we built Insperity Integra, right, which is a time-driven, activity-based costing
Right.
for Insperity clients. And it doesn't matter what kind of time tracking system you got, like T-Sheets is what we recommend. You get the timesheet into QuickBooks and the whole process is automated. Intuit Payroll now has that as well for QuickBooks Online. It just announced 2 days ago. And of course, Intuit Payroll for desktop has had time-driven activity-based costing and automatic job costing forever. But those are the only two ways that I know you can automate it. But even if it's manual, you can do it. Now there's a lot of things that you look for kind of success. I think you got a top 10 list of what are the drivers here for somebody who's thinking about this process.
Right, and this top 10 list, it's interesting where this top 10 list comes from, right? So
David
this is. I haven't seen David in a while.
No.
Good show, very good show. Now this comes from our own work together,
Mhm.
right? This top 10 list comes from a client we worked on together, right? Who worked through the process of selling the business. This top 10 list is a combination of perspectives that we assembled for this client before they started the process, and the understanding of the business that was validated by the buyers we spoke to.
Mhm.
So it's real sound, real world advice that comes from an engagement we both worked on.
So I feel like Paul Shaver. Number 10. So what did you find? What did we
So,
find?
yeah, and it's dramatic for the seller, it's dramatic for the business owner, because
Mhm.
he may not be hearing what he wants to hear.
Right.
But nevertheless, it's important to understand, right? So a couple of lessons, and pardon me if I refer to my notes, so I catch them all.
There's 10 of them.
There's 10 of them, and my memory goes to 6. We talked about the first one, which was recurring revenue models. And recurring revenue is really about predictability in the revenues. So if you can engage your customers or your clients in longer-term contractual relationships, that's really important. And we talked a little bit about quality of revenue. So it's the revenue type, recurring revenue,
Mhm.
right? Projects that last 3 or 4 months are difficult, and just that revenue won't be valued as strongly as other revenue. Termination on services clients, termination provisions. How does a client end the relationship with you? If they need to move on, and how much notice do they give you, right? These are important attributes. Is there a demobilization fee in the contract? If there is, that's very helpful, and it will add value to the business, right? Remember, you're delivering a valuable service to the client, and you should be fairly paid for that. So termination notice, demobilization fees where it's appropriate. Expenses, and this is an interesting one for us. This is a common one for a lot of owner-led businesses. They don't always track expenses consistently. They don't always separate owner discretionary expenses from the expenses of the business. If you own the business and you're running it as a lifestyle business, it's okay to run owner expenses through the business. A buyer won't see those as ordinary expenses for the business, which is fine. Those will get recast out. But at least make it easy to identify those discretionary expenses that reflect the owner's own lifestyle. Your country club membership, your automobile,
Right, meals.
right, meals, those sorts of things.
Right.
So make it easy so that they can be separated out, so that the real operating expense of the business can be shown. That's right. Really important there. Profits as well. Predictable profits rather than lumpy profits are going to be more valuable, right? So you want profits lead us to cash flow.
Right.
Predictable cash flow is easier to manage than lumpy cash flow. And if you're month after month drawing on your working capital line with the bank, right, that's a little bit tougher to manage than if you can predict it. And your banks do like the predictability as well.
Sure, everybody does, right?
Right. And as you manage your working capital line with the bank, what they like to see is, on a regular basis, you circulating capital through that working capital line. Right. So those are important. Collections, cash collections.
Mhm.
How do you bill your customer? How do you collect cash from the customer? A lot of project work gets started without a down payment, for example, an initial payment from the customer. In that situation, you're actually absorbing the cost of getting that project started, when some of that cost might be better shared with the client.
You're giving them an interest-free loan.
That's right, that's right. And if you're invoicing on a net 30 basis, at some point, after you've reached a milestone in the project, that could be a 90-day, 120-day
Sure.
interest-free loan.
Kill you. The faster you grow, the worse it gets.
That's right.
So day sales outstanding, DSO, becomes
DSO.
the number you want to put to work there.
That's a very important metric.
Mm.
But, and examining your order to remittance, as I call it, your OTR cycle.
Mhm.
What happens from the moment you get that order from the client, that contract signed, through to the time when you collect for the services you're delivering?
Mhm.
How long is that cycle? How many collection points are there in that cycle? How often do you invoice? How long does it take a client to pay?
Mhm.
Right. We like clients who pay by ACH or credit card, because you get, as soon as they initiate that payment, you have access to the cash.
Right.
Right, so the payment methods are really important as well.
We had Art Saxby on the show, and he talked about how we did collections for him. Our process was to call the client when we signed the contract, before we did any work, to understand what their approval process was, so that we could shorten that order to payment process down.
Right.
Yeah.
Good idea.
That's good.
Good idea. We talked about this one, but I can't tell you how important understanding customer profitability, product profitability, project profitability is in understanding the execution strength of your business.
Mhm.
And you should fully understand, at a very minimum, the top 20 customers, how profitable they are, the worst 20 customers that you serve, and how profitable they are or are not.
And that unit economics is also going to help you. Are you pricing your jobs right? It's going to help you figure out what's your ROI on your sales and marketing expense, which people contribute the most to profits. I mean, that has a lot. To me, that's the most important measure of all service.
And that's where you come in
Yeah.
with your services, is helping the business owner, the business leader, understand his numbers at that level of detail. And a lot of business owners just don't get there
Yeah.
until a firm like yours comes in.
Yeah. Above the line versus below the line cost, you have to have that at your fingertips.
That's right, that's right. We talked about owner expenses, making sure they can be separated easily and quickly. Also, your operating processes. How efficiently do you operate the business? There's a number of metrics that drive that, but the repeatability, the consistency, the automation, the technology, the impact of technology on your business processes is really important. You talk about using software to help streamline some of the data collection, data analysis, data reporting
Bill
functions
payment.
of the business.
Mhm.
Bill payment, automated bill payment. These are all functions that streamline the performance of the business, take cost out, and actually give you access to the cash, the rewards of your work,
Mhm.
that much more quickly.
Mm-hmm.
Very important.
Improving your unit economics.
That's right, that's right.
So we've worked a lot together, and a lot of different clients, and there's been a lot of lessons that I've learned from working with you and helping Growth Force be able to help the client get ready for an exit. So can you share some of those lessons? Do you have a top 10 list?
We do have a top 10 list, and this top 10 list comes from what we've learned as we've experimented in the businesses we've worked together on as well. It's also fed by the feedback we've gotten from buyers or outside parties. that we've engaged with on behalf of those clients. And I think it's a top 10 list that any CEO should be keeping in mind.
Great.
Right, so we'll run through
It's
it
a
very
great summary.
quickly.
That's
Run through. And I think the recurring theme through this top 10 list is predictability. Try and find predictability, consistency in the numbers, month to month, in the way you're running the business. So number one on the list is revenue. Predictable, recurring monthly revenue is highly valued. Right? Number two is expenses. Consistently capture your expenses and record them, categorize them consistently the same way, month after month, so that you understand, and once again, just like revenue, where they're coming from, where you're spending your money, right?
So that means a disciplined month-end closing process where you're recognizing revenue, you're accruing for payroll, and that P&L is really accurate.
That's right, that's right. Disciplined month-end closing, disciplined coding, your processes are repeatable. Right?
And believable.
Right, and believable. Third, same with profits. Understand where your profits are coming from, and strive for consistent, predictable profits as well. And that takes us to the project accounting.
Right.
You need to understand your revenue by product, by customer, by service line.
By
as you go
team,
forward.
by whatever it is you've organized yourself.
That's right, however you've organized. Good point. Next is cash and cash collections. How efficiently are you collecting cash for the work you've done? And where in the service life cycle are you collecting that cash? Ideally, collect it ahead of delivering the service, but if you can't do that, collect it immediately after you've delivered that service, rather than well after you've delivered the service.
So one of the first things you did with GrowthForce was looked at the order to pay process. Just talk a minute about that.
Yes, order to pay. I think about businesses as having two basic functions: inquiry to order. What's the sales cycle look like from the first time you touch a customer to getting the order? And then order to remittance or order to pay. How long or short is that cycle? How labor intensive is it? What's involved? Is it efficient? So you want to be collecting your cash as soon as possible, early in that cycle rather than late in that cycle.
So we had Art Saxby on the show, and one of the things that we do for Chief Outsiders is we call his clients as soon as he signs a contract and say, okay, we're the accounting department for Chief Outsiders. Our job is to help make sure that we're making it easy for you to pay our bills, and we find out what their process is to approve the bills, what supporting documents they want, who has to approve it, when do they pay bills,
Right.
and then this way, when we send the bill, we already have it ready to go.
That's a wonderful best practice. Really understand what the customer needs in order to give you what you need from them.
Yeah.
Yeah, very good practice. I like that. We talked about customer and product profitability, very important. Once again, understand it. Understand the top 20, the bottom 20 at the very least, if not all of your customers. How profitable. And consider restructuring the relationship, repricing the relationship, maybe modifying the service portfolio that you're delivering so that they become profitable. But don't be afraid to fire unprofitable customers.
Replace bad money clients with good money clients.
That's right. That's right. You'd be surprised at how much cash and profitability you might be consuming with unprofitable clients. Right? Next, OpEx versus CapEx. Lumpy spending is tough, right? So capital expenditures are big, infrequent expenditures. And we think about those in a lot of businesses as buying computing hardware or other things. There's every opportunity to outsource the purchase of the hardware to a managed service provider, so that what you're doing is turning capital expenditure into operating expenditure, which you can scale up or down based on need, right, based on demand. It's really important to be able to adjust the business spend based on the demand. Right? Scale your business quickly, reduce the business quickly. For example, if you lost an important customer because you just fired them, so what does that do for your expense line? If you want to be able to adjust quickly to that firing. So OpEx is very important.
You talk about taking your operating expenses and your big capital expenses and turning them from a fixed cost to a variable cost, and outsourcing does that, right?
That's right.
Art also said what he liked about GrowthForce was instead of having to hire a controller and have that fixed cost, he could just add services as he needed it.
Exactly, and the principle is there. That controller may not be you may not be keeping that controller busy full time. If you can be involved, you can hire GrowthForce to do that. You're buying that controller's time and expertise on a fractional basis.
Or an outsourced IT, or an outsourced whatever.
There's a lot of functions in the business and a lot of expenditures of the business that you can turn into OpEx and outsource.
Variable, yeah, good.
Right. Owner expenses, make sure that your owner expenses are easily separated from the natural operating expenses of the business. As an entrepreneur and owner, it's okay to run owner expenses through the business. Just make sure that when you're ready to engage with buyers, you can separate those out quickly and easily.
So that's like the country club, the car, and the meals?
At least.
Yeah.
That's right.
Right.
But a lot of owners will also use the company credit card to pay personal expenses and vice versa.
So that's an important lesson here. You pierce the corporate veil if you do that, right? You better account for that properly, or else
That's right.
you've lost your LLC protection.
Right, good point, good point. Your operating processes, where you can, use technology to enable and streamline your operating processes. GrowthForce is a very good example with expense reporting, time reporting, the analysis, etc. So technology-enabled business processes help streamline the business. And then the last item are your projections.
Mm-hmm. So talk a little bit about projections.
Right. Projections are a reflection of what your game plan for getting better is, what you're predicting for the future performance of the business. A lot of business owners are reluctant to do projections because they feel like it's committing them to the performance of the business in the future. Well, you need to get beyond that, right? First of all, who's better positioned to predict the performance of the business in a forecast than the business owner, the business leader? So I'd rather have you, Steve, making the forecast for GrowthForce than somebody else, a buyer, for example, doing that. Projections are built on a set of assumptions. Those assumptions change, but you need to establish the assumptions that the projections are built on.
Mm-hmm.
Right? It's okay if they change. That way, your forecast changes. You might lose a customer, you might gain 3 customers that you didn't expect to gain. But the forecast is a reflection of those assumptions and the way you intend to manage the business. And it's very important to understand that plan, that strategy and that plan. It gets reflected in the numbers. The numbers reflect the plan. The numbers are not the plan, right? So the plan will drive the numbers.
You know, you can wrap up here. You said something at the very beginning that I'd never heard before, is that businesses are sold, they're not bought. Did I get that right?
You're right.
So the forecasts relate to that? You know, give us a summary of a closing statement here on what that means and how all this comes together.
Yeah. And businesses are sold, not bought, just encompasses so much. But what it really means is when it's time to think about selling your business, it's time to button up all of the loose ends of the business. Make sure your projections are built on a set of documented assumptions, for example, that the game plan for getting better, growing the business, is really well formulated and well articulated and actually connects with reality, right? And the attributes by which you measure the strength or lack of strength in the execution of the business, we talked about R values, we talked about gross profit margins, customer product profitability. Those numbers do reflect positively on the business.
So if somebody wants to hire Jeff Brown, how do they get in touch with you?
You certainly can reach me through Steve King and GrowthForce,
Yes.
because we work together on a lot of customers, helping them get better, a lot of clients helping them get
Being
better.
a force for their growth.
Being a force for their growth, that's right, putting their numbers to work, right? Or you can reach me directly at quorumgroup.com.
Quorumgroup.com.
Yes.
Well, thanks, Jeff. This was fun. I learned some things today, and I hope our listeners have learned, and I want to thank you for all your advice and counsel over the last 15 years. I have only 3 people on my advisory board, and I'm proud to have you as one, and I hope our listeners to the show have learned from some of the lessons that I've gained from you.
Well, Steve, appreciate that. That's high praise. I'm glad to be on the board. I'm glad to be working with you, and I appreciate this time together.
Great.